Today on Forbes, new Trump financial reporting rule aims to capture cash transactions as low as $200. The Trump administration is seeking more information about your financial transactions, but only if you live or do business in one of 30 zip codes. Beginning in April, the Department of the Treasury's Financial Crimes Enforcement Network, or FinCEN, will require persons in those zip codes, estimated to be more than 1 million Americans, to be reported if they try to spend more than $200 in cash or cash equivalent on items like money orders and traveler's checks. That's a dramatic expansion of the standard $10,000 cash reporting requirement. The new Geographic Targeting Order, or GTO, which has, as its stated purpose, quote, to further combat the illicit activities and money laundering of Mexico-based cartels and other criminal actors along the southwest border of the United States, was quietly introduced earlier in March. The GTO requires all money services businesses located in 30 zip codes across California and Texas to file currency transaction reports, known as CTRs, with FinCEN at a $200 threshold for cash transactions. The threshold for all other areas remains $10,000. The order applies to money services businesses in zip codes across these 7 counties in California and Texas: Imperial County, California; San Diego County, California; Cameron County, Texas; El Paso County, Texas; Hidalgo County, Texas; Maverick County, Texas; and Webb County, Texas. A money service business, or MSB, includes businesses like check cashing services, sellers of traveler's checks or money orders, and money transmitters. The effective date of the GTO is April 14, 2025. Under current rules, financial institutions, including banks, must file currency transaction reports when they accept $10,000 or more in cash in a single day. The term cash typically means money. Money can mean currency and coins of the United States and any other country. Cash can also include certain monetary instruments like a cashier's check, bank draft, traveler's check, or money order. A CTR includes details about the person involved in the transaction, including their name, address, and taxpayer identification number. A CTR also contains information about the date, amount, and kind of the transaction. After the CTR has been submitted, FinCEN collects and maintains the information, and authorized law enforcement or other agencies can use it to investigate and prosecute illicit finance activities. It is not illegal to deal in cash, even if those dollars are significant. The idea of reporting large transactions that enter the country via a FinCEN 105 are deposited or exchanged at banks or other financial institutions via a FinCEN 104, or are received in the course of a trade or business via Form 8300, is to ensure that those dollars are properly reported and taxed. Money that is so-called dirty, meaning that it was from illegal sources, is more difficult to circulate and exchange for so-called clean money if reported. Similarly, it's easier to ensure that funds are reported to the taxation authorities, if appropriate, when taxpayers are aware that the feds know that those funds exist. The $10,000 threshold, established in 1972, has never been adjusted for inflation. If the threshold had been adjusted for inflation, it would be nearly $80,000. According to the Government Accountability Office, financial institutions filed roughly 167 million CTRs in fiscal years 2014 to 2023. Adjusting for inflation would have reduced the number of CTRs filed by at least 90% annually since 2014. That $10,000 threshold isn't an absolute bottom limit. If a financial institution or MSB has reason to believe that a transaction was out of the ordinary, even if it's for a much smaller amount of money, they must file a suspicious activity report. That includes structuring, when you break down really large transactions into smaller ones. For example, if you had $100,000 in so-called, quote, bad funds that you wanted to get rid of, rather than putting it all in at once, you might break it down into 11 deposits of $9,091 to avoid being reported. Doing that with an intent to evade reporting is illegal. For full coverage, check out Kelly Phillips Erb's piece on forbes.com. This is Kieran Meadows from Forbes. Thanks for tuning in.